Okay, next segment. I call it Loans 101, and I've been using the same story, the same explanation for Loans 101 for my entire 20-year career. It's how you are seen as an expert to the client. You have to explain loans to them in a way that's simple and is not too much detail. I think one of the biggest mistakes loan officers make is giving borrowers too many choices and too much detail. My job is to understand their situation and give them at the most 2 choices, never 3. 3 choices confuse people. When they get 3 choices, they leave to think about it. When they leave to think about it, they don't come back. They talk to a couple other people. Someone says their friend was really nice and really smart, and they go see someone else. 2 choices, that's it. That comes from parenting. You got a little kid, they don't want to go to bed. You say, hey, you can go to bed, or you can have no TV tomorrow. Which one do you want? And they go to bed. So use the same thing with our clients. I know it seems simple, but we got to do that. So Loans 101 goes like this. Listen, I want to explain to you, the borrower, a couple things about loans and how they work. I've been using this explanation my entire career. Loans, no matter what you hear in the news, have not changed in the last 20 years. The rules have changed slightly, this way, then that, but how they work and how they're categorized hasn't changed at all. There's only 3 kinds of loans. There's government insured loans, there's government regulated loans, and there's portfolio loans, and that's it. And there's only really 3 ingredients. Cash, that's your money. Credit, how you make your payments. Income, how much money you make. So if we compare and contrast the 2, about 97% of all closed loans fund in either a government insured or a government regulated loan. Government insured is FHA and VA. Government regulated is Fannie Mae and Freddie Mac. Have you heard of those guys? Yeah, we heard of those guys. Well, those guys got in trouble about 10 years ago. They got too lenient on doing loans. And the problem is everybody had to pay the price. So what happened in the market back then, so you know what happened, is loans got way too easy to do. The 3rd category, the portfolio lender, started making loans with less and less rules, and they dramatically increased the supply of buyers. So all of a sudden there was a high number of buyers with the same number of homes. Well, simple supply and demand tells you that's going to drive prices up. So then everybody who could build a house started building houses, and they overbuilt, and people were speculating, and people were doing greedy things, and it was bad. And now there was way too many houses. Slowly, people stopped being able to make those payments, and the supply of buyers went way down as those companies that were too lenient made and got out of business. So now we had way too many houses, but not enough buyers, so prices went back down. It had to happen. So since then, there's been so much regulation that now people say, well, gosh, loans are so tough to get. Loans are easier to get today than my first couple years in the mortgage business, and that's the truth. So that's how the loan history worked. So when we compare and contrast the 2, government and conventional, because that's 97% of all closed loans in America, government loans have way less down payment, 0 to 3.5%. Conventional is usually more like 10% or more. This is how I tell the story. I know you can do a 5% down conventional. What I tell them is 10% or more, because 10% or more is when it makes the most sense. When it comes to credit, government loans actually want a credit score of 640 or higher. Sometimes they'll go as low as 580. When it comes to conventional, they usually like 720 or higher. Anything below 720, they really ding you on the rate. Make sure you tell them that part, because it's true. Now we go down to the 3rd category. When it comes to income, government loans are more lenient. They require less time being self-employed in some cases. They'll let you spend 41% of your income on your house payment plus your bills. Now listen, I know they go higher than 41%, but you can't send people out the door at their max qualification and think that you're going to manage their expectation and take good care of them. That don't work. So I qualify them at 41. For conventional, the book says 38%. So that's what I say. 38% of your income can be used on your house payment plus your bills on a conventional loan. Now, the most important part, I say, what are you paying rent right now? They tell me. What's your comfort zone for payments? They tell me. I write it down. Now, as I spin the piece of paper around, and I say to them, now, based on the information I just gave you, which loan program do you think's best for you? So when I do that, I'm putting the power in the borrower's hands. I don't care what loan they pick. Now, I gave them two options, like I taught you, and they're going to pick one. Now, if they're wrong, I'm going to gently nudge them in the right direction. Well, I think we're government. Well, we're going to see, but you talked about putting more money down, or when we were talking, you said you might have more down payment. We'll consider both. Oh, okay, that sounds good. But I'm going to give them a choice and then spin it back around to go through their stuff. Now, right in front of them, they've got their pile of documentation. I'm going to look through it and qualify them right in front of them. No, I do not look at their stuff before they come in. It's not that hard. 2-year average of income, make sure it's not going down. Look at the bank statements. Any crazy deposits? No problem. Look at their credit. Read the credit report in front of them. Ask them the stuff and tell the answers right on the credit report. Why were you late? Write the answer down. What happened in your bankruptcy? Write the answer down. Right on the credit report so you can do the letters of explanation with them later. You've got everything you need right then and you can read the deal. Then you pick a program, you spin them around, show them that there's, on the computer screen, if you'll notice behind me, I have two monitors. One, they're the same monitor, they mirror the same information. So the borrower can see me entering the information around their qualifications. I think that's a big deal. Whenever I didn't have a dual monitor, they'd be leaning this way and leaning that way, trying to see what I was typing. And once I had two monitors, I could see that they trusted quicker and easier what was going on, and it made the process smoother. So then we pick a program, we pick a sales price, we go over down payment and closing costs. It doesn't take that long. That part of the loan should not take that long. So at the end of that, you ask them, how do you feel? That's an important, each step as you go through the presentation, how do you feel? Whenever you're wanting to move forward, you say, how do you feel? Not what do you think, how do you feel? And they'll tell you, I feel great. If they say they feel great, it's time to keep moving. If they say they feel confused, it's time to revisit. It's an excellent stepping stone to go to the next part. So always use that when you're moving from one step to the next during these 5 stories.